and at other times, but we're specifically focusing on Delaware statutory trusts. So a little bit about me, like Jamie says, my tax credentials are CPA, EA, and USTCP, and my financial planning credentials are CFP, PFS, and AEP. So they're all spelled out here. And I've been a tax professional since 1986, and I'm a national tax speaker. So I travel all over the United States, presenting tax presentations about tax planning and tax preparation to tax professionals and financial advisors. And most importantly, I'm teaching income tax at the College of San Mateo. I'm trying to fill the pipeline of new, more tax professionals, and it's been great. Many of my students are getting hired, and that's great to see and great to hear. So let's get started. What we're going to talk about today. So we're going to talk about number one, what are DSTs? Number two is how do you get them? How do you acquire them? The tax reporting issues we run into with DSTs, state tax reporting, that's a big, big, big topic, and depreciation calculations. That's a big subject in itself, and that's a very important one because you want to make sure you calculate those correctly. And then we're going to have a case study on how to report it on your tax return. So that's what we're going to be talking about today. So first of all, let's get started with Delaware Statutory Trusts. Well, before Delaware Statutory Trusts, a lot of investors were investing in real estate via what's called TICs, tenants in common, and those were in fashion. Probably, I saw a lot of those in the mid '90s. Probably, and, you would own office buildings or commercial real estate, and there were a lot of challenges with TICs, tenants in common. The thing is, it's limited to 35 investors. If you want to get a mortgage, each investor has to supply their private information to the bank. So the bank's going to have to review up to 35 people's financial information to get a loan. So the loans are never, usually not the best loans. Not the best rates, not the best costs. And also, everything's proportional based upon your investment into the TIC, and everyone has to agree. And there's no one really in charge. So, there were some problems, especially during the financial crisis we had in 2008, 2009. A lot of the tenants of these office buildings were mortgage companies. Well, a lot of them went out of business. So when their tenants are gone and these buildings had mortgages, well, the investors are still stuck paying the loans and paying all the costs on them. So a lot of them went to foreclosure and didn't work out that well. So we don't see those that often. They still do exist, but not as much as we used to see. So what's really taken their place is what's called a Delaware Statutory Trust. The state of Delaware provides this law to set up these business trusts. Now, these investments are all over the United States. They're not out of Delaware, but that's the name of the type of trust it's set up with. But they all have their own state filing requirements based on which state the property is located. So with the Delaware Statutory, it's a separate legal entity. It's a separate legal entity. So that trust, not the investors, will hold title to the property and guarantees the mortgage. And so what that means is the DST tend to get very competitive loans. It's easier to get financing because the bank is only dealing with the trust, not with the investors. There's an unlimited number of investors. You get a trustee who's managing it, so someone is in charge. And the advantage of DSTs is that the properties are investment grade properties. It's probably better than what your amateur real estate investor can get. So they tend to be investment grade properties. With the better operators, they go through a very strict vetting process to make sure this property is going to perform as promised and as guaranteed. And the units are smaller. Unlike buying a single piece of property, which could be millions of dollars, you can buy smaller units. It depends on the provider. Some are as small as 10,000, some are 100,000. It depends on the specific provider of the DST. So what advantage does that give you? It gives you a chance of diversification. It could be geographic diversification. We want to be in Florida, Texas, or Utah, or whatever. Geographic diversification. property type of diversification. It could be multi-unit apartments. It could be an office complex, a warehouse, or whatever types of properties. So you can diversify by types of properties. Um, or instead of putting all your eggs in one basket, you can diversify in different DSTs. It's great for estate planning. For example, let's say you have some children, and let's say you have 3 kids. Well, instead of having to have them split up an existing a DST when you die, just buy 3, and each one gets a specific one. So much easier to deal with. Like any other investment, you still got to do your due diligence with them. Watch out for the costs. Are there high commissions up front? Are there high ongoing management fees? What kind of surprises that might come up? So watch out for the costs. Manage your experience. Is it someone you've heard of? Is it someone been in the industry for many, many years? They have a deep bench of people. They have experts running this, real estate experts, finance experts, economists, all kinds of backgrounds here. It's very, very important. Unfortunately, I've seen clients find DSTs on the internet. And it's like, it's a bunch of amateurs who put together a DST, and I have some concerns about that. So, some deep manager experience is very important with the DST. So for estate planning, um, upon the death of the owner, you can get a step up in basis. We're here in California, and California's a community property state. So you get a full step up in basis upon the death of the first spouse. In a common law state, of course, there's a half step up in basis, but that's a serious consideration. And the transfer can be done via living trust or maybe transfer on death. I mean, there's different ways of titling it, but check with the provider. They might have some preferences how they prefer you to title your interest in the trust as easily as possible. Also, you can get a DST that's not leverage, which means there's no mortgage on the property. That's certainly a consideration. Or get one with a mortgage. And one advantage of that is that you can magnify your investment. If it comes with a loan, you might be able to make a larger investment, might give you a larger possibility of a better rate of return. Or your exchanging a property that comes with a mortgage. Your existing property had a mortgage, and so we probably need some debt there. So there's some careful calculations that need to be done with debt issues. We just got to watch out that you don't get into what's called a boot situation. Now, boot is taxable in a 1031 exchange, so we got to be really, really careful about that. And this is why I always advise investors that keep your tax professionals involved when you're in a transaction. Don't tell them at tax time because you might get a rude surprise. Keep them involved, have them review the numbers to see if there's simple ways of avoiding boot. With most DSTs, they tend to be new property or a newly remodeled property. If it's an acquisition of an older property, like let's say an old hotel. We've been to a lot of hotels that look kind of tired, so instead of remodeling, they'll just sell it. And then the new owner will spend the time and energy to remodel the property. So most DSTs tend to be new properties. So as such, it's not going to need a lot of renovation expense or structural modifications. But again, that's one of the due diligence you look at is what's the state of the property? Is it brand new? Is it recently remodeled? Or is it an older property and we're just taking it over, but then we're going to have to remodel? Now, if you're going to remodel, that's going to affect your cash flow, right? Because if your property is being remodeled, it's not going to be generating as much income or any income at all. So that's a factor to consider. Now, the DSTs themselves do not deal with the tenants directly. What tends to happen is they have an operator that they have a master lease arrangement. So the operator takes care of all those details with the tenants, with the maintenance, upkeep, and all those issues. So the DST itself is not handling all those very minute details. So there's master lease agreements there, and part of your due diligence, you want to read the master lease agreement, see what it says, and see what's covered, what's not covered, and see if there's any surprises. And sometimes it's a good idea to get a real estate lawyer on your team to review it too, because we might not have the expertise to understand the intricacies of these lease arrangements. All right, so that's a background on DSTs. Now, how to get a DST? Well, there's multiple ways of getting them. The most common and the most tax efficient way to get a DST is via a 1031 exchange. And Jamie does a great seminar about 1031 exchanges. We have many investors who had their rental real estate for decades. It's fully depreciated. They're now in their 80s. Do they really want to continue to operate or manage a piece of property? Can they find a property with the appropriate economics? So instead of doing a 1031 exchange to a single family home or apartment complex or whatever, you can do a 1031 exchange into a DST. Well, the IRS in Revenue Ruling 2004-86 has basically blessed DSTs as qualified investments for 1031 exchanges. Now, the IRS gives us some very, very specific rules on that. So as long as you follow those rules, it would qualify for a 1031 exchange. And all the credible DST operators know this ruling, and they're going to do their best to make sure the investment qualifies. So that's part of the due diligence you're reading. And in the private placement memorandum, you'll see a letter from a tax attorney or a CPA giving their opinion that this will qualify for a 1031 exchange. So that's part of the documentation you'll be getting. So that's really important. So what's the advantage of a 1031 exchange? It's a way of deferring the gain from the existing property or relinquished property to the DST. And most importantly, time value of money. So for example, let's say you sell a rental property and you say, hey, I'm just going to sell it, pay the taxes. Well, you run the numbers and let's say the tax bill, let's say it's $700,000. Well, okay, what's the advantage of just selling it and taking the money? Well, you got to pay $700,000. That's $700,000 that is out of your portfolio. That's $700,000 that's no longer working for you. So to take advantage of time value of money, you reinvest the entire principal of the existing property and don't pay the $700,000. So just think of that $700,000 continuing to work for you. Now, it depends on what the return's going to be on the DST. It could be 5%, 6%, 4%, depending on the type of property it is. But that's a whole lot better than nothing, right? Or a whole lot better than not having that money. So if you have a large tax bill, that's certainly consideration. Holding the DST until your death, you get to step up in basis, then your family eventually can sell without any capital gains consequence. Or better yet, they hold on to it with the step up in basis, they get additional tax shelter via depreciation. So that's very important too. And in general, these are professionally managed properties, investment grade properties. So they're going to have better returns than your single family homes or, small residential rental properties. So, and I've had clients who are complaining, oh, Larry, now I got to pay more taxes. Well, yeah, because you're making more money. Of course, you're paying more taxes, and that's okay. Nothing wrong with that. So 1031 exchange is a great way of acquiring DSTs. Well, that's not the only way you can get. You can just buy them, just like any other investment. You can buy them just whatever the price is, you can purchase it. So that's one way of going. Another way is just buying them, whatever their prices are. It could be part of your diversification strategy in your investment strategy. You have some stocks, bonds, and this could fulfill the real estate portion of your asset allocation. The other way to get a DST is via gift. You can receive it as a gift. Or if you're the owner of a DST, you can gift it to a family member. Again, checking with the DST operator on what the restrictions are and how easy that is. But it can be gifted. So what does it mean when you gift it? Well, if the gift is greater than the annual exclusion amount, which is currently $18,000 for 2024, and if you're married, that's 18 times 2, so that's $36,000. So the amount above that is subject to gift tax, and you'll file a gift tax return form 709 to report the gift. Of course, we're going to need to get a valuation of what the value of that gift is, so we know what to report on the gift tax return. You decide to make it a gift, or if you're a recipient of a DST via gift, you will have what's called a carryover basis. What the basis in the hands of the donor will be the basis in your hands. So you just continue the depreciation and those type of calculations. You'll just take over. Why do clients consider it a gift? Well, it could be a really good estate planning strategy, especially now, because for 24 and 25, we have a very high estate tax exemption amount. For 2024, that's $13,610,000. So that's for a married couple, that's 27 million. So you won't be paying a gift tax unless you give away more than 27 million if you're married. However, in 2026, we're expecting the lifetime exclusion to drop in half. So in 26, it might be 7 million. So for if your estate is larger than the current exclusion amount, you might want to consider doing some gifting to take advantage of the higher exclusion amounts we have for 24 and 25. So that's a whole other discussion here, but that's for estate planning purposes. It might make sense to make a gift. Now, of course, the depreciation basis is the lesser of the adjusted basis or fair market value. Well, in general, my expectation is I don't expect the DSTs to go down in value, I hope. So the fair market value is most likely not going to be less than fair market value, less than adjusted basis. All right. Another way of getting a DST investment is inheriting it. If you inherit the DST, so that could be as a result of the estate plan via living trust or through titling such as transfer and death or something like that. Now, when you inherit the DST, if you're the donee, you're the recipient of the property, well, you get a step up in basis. So if that were to occur, we're going to need to get a valuation of the property, an appraisal or something like that to give us a calculation of what that step up is going to be. And for the person who passed away, that's something that has to be done anyway, because that's going to be needed to be reported on their estate return, the Form 706. So if you're inheriting a DST, you can get a significant increase in depreciation, gets a step up in basis, because for many people, they're going to have a low basis in the DST because they're deferring a lot of gain from the relinquished properties. And we'll talk about on the depreciation discussion, how to calculate depreciation based on these different ways you acquire the DST. Okay, so let's talk about tax reporting issues for DSTs. So first of all, a lot of people hear the word trust. Oh, it's a trust. It's a trust. So shouldn't I be getting a 1041 K1? That's the K1 you get from a trust. Well, this is a business trust, so there will be no 1041 K1. There's not going to be a 1099 either, unlike a mutual fund, unlike a REIT. So you're not going to get a 1099 DIV or anything like that. So it's not reported on Form 1099. But what you will be getting is what's called a beneficial ownership interest statement. It's going to be a letter, a grantor letter. And the letter is going to break out all the information you need to report on your tax return. It's similar to a grantor trust. A grantor trust will report any interest, dividends, or capital gains. In this case here, it's going to be an operating statement because it's an operating property. It'll show the gross rents and the expenses. But when you get these, or you're going to give this to your tax professional, or if you're the tax professional, make sure you get the entire package. Usually it comes in a PDF. You'll get an email saying, okay, log into our portal, download your letter. I don't think they mail them anymore, but so that's something to keep an eye on. And also check with the DST provider on when to expect these letters. Do we get these in March? Do we get these in April? When do we expect them? And throughout the year, you should be getting correspondence from the DST provider about performance of the property, occupancy, if there's any unusual expenses coming. So you'll know what's going on. It's always nice to read these letters to get a sense of what's going on. Also, before you buy the DST, it's a good idea. Do your research, read the private placement memorandum that you get from it. It's a very thick document, but also, so it's a good idea to go visit the property. You can call the DST provider and says, "Oh, okay, I'm making a significant investment here. Especially you're making $1 million investment. You might want to check out the property, check out the